Hello, everybody. Today we're going to be talking about covered calls, naked calls, and cash secured puts. Thank you for joining me, by the way. This is episode 2 of Options 101. If you haven't seen the first episode, I'd highly recommend you watch that first because some of the information in this episode is going to be building off of the information from that episode. So let's get started. So what is a covered call? As we learned in the previous episode, if you sell a call, you are giving the buyer the right to buy your shares at a specified strike price. So a covered call is going to combine two different actions. You're going to buy 100 shares of a stock, or it's possible that you already own those shares, and then you're going to sell a call. Sometimes this is called a buy right. It just depends on the broker, the person. People like to call them different things, but a covered call strategy and a buy right strategy are the exact same thing. Buy right refers to buying the 100 shares and then writing a call, which is also the same as selling a call. So let's explore the effect of the strategy. So let's assume you buy 100 shares of SPY for $300 each. 300 times 100 is going to be $30,000. That's the capital you're going to have to put down for those 100 shares. You're going to have an average share price of $300, and then you're going to sell a call for $2 with a strike price of $300. So time goes by and eventually you get to the expiration date. So let's imagine SPY is now trading at $299 when the call option expires. You will not have to sell your shares and you'll keep your $2 in premium. That $2 times 100 shares equals $200. You receive $200, but the share price did decline by $1 and you hold 100 shares, so that's going to be negative $100. So net, you ended up making a $100 profit. Another way to look at this is that you are lowering your cost basis or your average cost. So some people prefer to see this as the option expired worthless and your average cost is now $298 per share rather than the $300. This is just another way to look at it, but in that scenario, your cost basis is $298, the stock is trading at $299, and you own 100 shares, so that would still be your $100 profit. It's the same thing, just another way to look at it. So in this scenario, let's imagine SPY is trading at $305 as the call expires. So you're now required to sell your shares for $300 each. You paid $30,000 and you received $30,000, so that nets out to zero. You were given $2 per share, so you're going to get $200 per share and you're going to make $200. That's great. The only downside is that if you had only held the shares instead of selling the call, you would have actually made $500 instead of that $200. So that is something to consider. So as you can see, a covered call is capping your upside gain and leaves you exposed to downside risk, though it is slightly less compared to if you only held the underlying stock. Because if the stock drops dramatically, at least you'll have whatever compensation you got from selling that call. The downside is if the stock moves upward quickly, you're going to lose out on all the gain and you're only going to keep whatever that small amount was that you sold the call for. So for example, if SPY dropped to 290, you would have a loss of $800 instead of $1,000. But again, if you think about it in terms of if it went up to 310, you'd have a gain of 200 instead of a gain of 1,000, which is obviously a lot. So let's explore a naked call now. So most naked calls are bought rather than sold. Selling a naked call leaves you open to unlimited risk, and most brokers are reluctant to allow this unless you have a large portfolio. Most require well over $100,000 to sell naked calls, and if you're watching this video, I would highly recommend not selling naked calls. It will not end well. So let's look at an example. Let's say you sell a Tesla call with a strike price of $350 for a premium of $5. Elon Musk then tweets that he's taking Tesla private at $420. Tesla immediately jumps to $400, and your option is exercised. So you're going to be forced to buy 100 shares at $400 per share. That's going to cost you $40,000. Then you're going to be required to sell all 100 of those shares for $350 because that's the strike price of the call that you sold. So if you look at the math equation on the right, you're going to lose $40,000, you're going to gain $35,000, and you're going to gain $500 from the premium, which is that $5 times 100 shares. So net, all in all, you're going to end up with a loss of $4,500. This is a good example of why you shouldn't be selling calls unless you really know what you're doing. And I don't mean by watching this video. Even institutional investors don't really sell true naked calls. They use something called delta hedging, but that's a little bit advanced for this. We're not going to really talk about that. Moral of the story, don't do it. You're going to lose a lot of money. Okay, so as you can see, there is unlimited downside while your max gain is capped at the premium you receive for selling the call. On the flip side, if you buy a call, your max gain is unlimited while your max loss is the purchase price of that call. So let's quickly take a look at the other side of this trade. So let's say you buy a Tesla call with a strike price of $3.50 for a premium of $5. Elon Musk then tweets that he's taking Tesla private at $4.20, and Tesla immediately jumps to $400. Your option is then exercised. So for the purposes of this example, let's assume the stock price doesn't move from 400 in the real world. You would just sell the call, take your money, and move on. But for this example, let's pretend that the option stays the same price and we're going to execute it or exercise it. You're going to spend $350 per share. That's going to cost $35,000, and you'll immediately be able to sell those shares back to the open market for $400. So as you can see, that's going to net you $5,000. But you did also pay $5 in premium to have that option. So you're going to have to subtract that. But all in all, you'll end up making $4,500. If you're new to options, you just want to try something and you don't know whether to buy or sell a call, you're going to want to buy a call. And this is the reason why. Because if you sell it, you are opening yourself up to unlimited losses. And like I said, most brokers won't allow it, so it's not something you need to think about too much, but it is something to be aware of. Okay, so now we're going to talk about cash secured puts. So a cash secured put is a position where your broker sets aside cash and allows you to sell a naked put. I put it in quotes because it's not really naked. What's really going on is it's more similar to a covered call, where the cash is the collateral and you're being given the ability to sell the put by your broker. So just remember that if you sell a put, you may be obligated to buy a stock at a certain price. So this strategy is often used by someone who wants to buy a stock but thinks it is a little bit overpriced. A risk is that the premium you make may be less than the gain you would have made if you would have just bought the stock at the current price that it was at. The other issue with this is if the stock decreases in price dramatically, you're still going to be forced to buy the stock for that higher price that you sold the put at, and so you can lose a lot of money that way too. So let's look at Starbucks. Starbucks is trading at $90, but you think it's worth $88 because one coffee costs too many bucks. Ha ha ha. You decide to sell a put at $88 for a $3 premium. So time goes by. So Starbucks is now trading at $89, which is $1 above the strike price of the put you sold. Because it did not reach the strike price, you will not be forced to purchase 100 shares and you will keep the premium. So you got $3 per share, and that was for 100 shares because that's the standard amount of an options contract. And so you made $300. Additionally, if you had decided to buy the shares at $90, you would have lost $100 and received no premium. So this is a good example of where selling a put makes a lot of sense and you'll actually come out ahead. But now let's imagine Starbucks is trading at 84 instead of 89. Because it did reach the strike price, which again was $88, you must purchase 100 shares for $88 each. You'll get to keep the premium, but you'll see you're still going to end up in a loss. So you have those 100 shares that you purchased for $88 per share. So that's going to cost you $8,800. You then got $300 via the premium, which is great. And then the cost of the shares is now $84. So let's assume you're selling them right now at the market price of $84. So you're going to receive $8,400, and the net of that transaction is going to be your negative $100, which is a loss. Again, this still is better than just buying the shares at 90. At 90, you would have had a $600 loss. So again, this is a great example of how if you want to own the shares, but you want to own them for a slightly lower price, this is a good option. The only downside to this is if the stock price goes way up, If you had just bought those shares, you would have had more. Again, it's very similar to the covered call. You would have made a lot more money. So in the previous example, we saw a loss of $100 when we sold the shares. Many traders will sell a put because they want to own the shares. In that case, they bought shares they believe to be worth $88 a share for $85 per share. It's that 88 strike price minus the $3 in premium, and that gives you your $85 average cost or cost basis. This strategy can be a win-win if you want to own the stock. The only risk in that case is that the stock rises more than the premium you receive. So for example, you sold that 88 strike you sold that 88 strike put and you got $3, but guess what? It goes up from 90 to 100. So if you just bought those shares, that would have been a $10 per share gain, and that would be $1,000 that you made. Whereas in this case, instead, you only made $3 or $300 because you decided to sell a put instead of own the shares outright. So up next, we're going to be talking about a call diagonal spread. We're going to be talking about a put diagonal spread, and we're going to be talking about iron condors. Beyond that, we're actually going to be able to get into more of the cool option stuff. This is still pretty much foundational beginner level options, but eventually we're going to get into more time value of money stuff, going to get into Greeks, and we're going to get into a lot more interesting things, so stay tuned for all of that. Thanks for watching. Don't forget to comment below if you have any questions. I will answer any questions that you guys have. I'd be happy to explain things if they're not clear. So like and subscribe and look out for those new videos. Thanks so much. Have a good one.